computer. Okay, so anyone watching this later on, this is the open call. We're recording this in the afternoon of Thursday, June the 11th, 2026. Question and answer. I'll do my best to answer any specific questions on markets or macro or whatever. Yassine has a specific question for us. Let's go, Yassine. What's the question?
Okay, I will start with the first question. The first question is about the last NFP, the second one is about the last CPI, and the third one is about the last PPI.
Okay, I'll do my best to remember all of those. Okay, go for
uh,
it.
and I try to come up with some potential answer. Maybe they are wrong, maybe they are incomplete, but I would like to share that with you.
Great.
So,
Okay.
as everybody know, the NFP came in higher than expected, outside the range of estimate.
Yep.
The market priced in a full hike for December. And to be honest, I didn't expect the market to price in a full hike by December, and I didn't take that trade. Why? Because first, everyone is expecting the US economy to be strong. Thereafter, everyone is expecting a strong NFP, or the bias for the NFP number will be higher.
Sure.
Second, the focus of the Fed and the market is regard inflation, and as we know, the average hourly earning came in line. And third, the 2-year not futures was at the bottom, so I didn't want to show the bottom. And my question for you about the NFP was my interpretation for the NFP objectively wrong, or when it's come to this kind of judgment, there is no objective wrong or right. This is why we call it discretionary macro trading.
Exactly. Well, first of all, okay, so the general question, as always with data, is you have to understand what the market is expecting. Secondly, as you know, Yassine, very well. Secondly, you have to try and understand where the positioning is a little bit. That's very important. And also to try and understand the narrative. So we'll get to the specifics of the NFP data last Friday, I suppose. But the important thing to understand, especially when we're talking about bonds and the Fed, hi John, and trading and whatnot, is that remember that when we talk about what's priced in, it's actually a distribution. It's a distribution of probabilities, by which I mean it's not a binary yes or no. It's not, oh, the Fed will hike or the Fed will cut. So the thing is, any kind of trading around data or interpretation of data, you have to understand that it's shifting probabilities. When I used to teach in the old days, I always used to say that it's not yes or no, it's a question of probabilities. And you see that very well if we go to the the CME tool. Can you guys see the CME tool here?
Yes,
Okay,
and
coming up.
before the NFP print, the market was pricing 50-50 chance for a December hike. I just
Let's have a
didn't
look at it.
justify that full price in.
Because the thing is, it's not 50-50, because if we look at December, so let's just first of all understand what's going on here. So this is December. Can everyone see this? So what is this telling us? This is where we are now. It's a target range between 3.5 and 3.75%. Everyone agree? So the question now is, guys, is this 50-50? What is this pricing in at this point? What I want you guys to look at is to see that it's actually a distribution. So technically, some people, only 0.1% of the market, but some people are saying that the Fed will hike once, twice, 3, 4 times. Okay? So what I'm trying to say is that just before we get back to oh my God, my computer is so slow. Sorry, this is annoying. Oh, I just went back. Okay, that's going to upset. Can you hear me okay?
Yeah.
Yes.
Strange, because when I click, it takes about 30 seconds to change. So what I'm trying to say is that when you look at what the Fed is pricing, we have to understand that it's an agglomeration of different probabilities. So again, to go back to the FedWatch tool, which hopefully will be quick, if my computer, can you see it now, guys? Yeah, you can see it.
Yes.
Yeah. See what's happening is that 46.2% of the options market is pricing no change. Okay. 1.6% is actually pricing a cut. 39% one. So what I'm trying to say that, for example, the market is pricing one cut by December is technically not correct. What it's pricing, this is the distribution. So when we see what's priced in, what you actually need to do is to do the following calculation. Now, if we assume that every hike or every cut is 25 basis points, that's the standard in the industry, right? So technically, sorry, someone's got a noise in the background. If you could turn it off, that'd be great. Thanks. So technically what we have to do is to say, okay, 46.2% times 0, no change. 1.6% times negative 25. 39.3% times positive 25. 11.5 times positive 50. 1.3 times positive 75. 0.1 times positive 100 basis points, right? Now, if you put those all together, that will give you a number. And actually on this, they actually have it. And they have it in the aggregated, right? They have it in the aggregated. So now if we go there and look, it says, oh, 35%, 35.22% doing nothing, and 64.78% saying one hike. So the thing is that, journalists are very lazy. They would say, oh, there's a 64% chance that the Fed will hike. But mathematically, that is not correct, because we saw it's actually, there's a distribution of probabilities. These are aggregated. So what's the point I'm trying to make here? The point I'm trying to make is that when you read on Bloomberg or you're here and people say, oh, there's a 65% chance of one hike, that is actually an agglomeration, an aggregate of all of the different probabilities of what people, some people think 2 hikes, some people think 3 hikes. Where do these numbers come from? These numbers come from the option chains, overnight interest rate swaps. There's some people out there who think the Fed will hike twice. There's some people who think the Fed will do nothing. There are some people who think the Fed will cut twice, maybe only 0.1%. So why am I saying all this? Just to keep our life simple, one number is nice to have. So we go, okay, the Fed is pricing in 60% of one hike. Great. But here's my point, Yassine. When we trade data, all the market is doing, the market is not making binary decisions, yes or no. The market last Friday was not saying, oh, the Fed will hike because of NFP, or, oh, the Fed will not hike. What is actually happening mathematically is that all of the different instruments, the 2-year bond, the 10-year bond, SOFR, December 26, December 27, et cetera, everything, every single instrument, FX, gold, everything is changing the probabilities, but specifically in the bonds. That's all they're doing. So what you have to think of, Yassine, is not, well, it was priced in. Why did the market move so much? What was priced in was a very specific, we would have to go back and look exactly at all of the different probabilities, and you'll see that it moved. Maybe it moved 1 basis point. Maybe it moved 6 basis points. Actually, I was trading that morning and it moved about 12 basis points. So what does that mean? That doesn't mean the market suddenly says, oh, the Fed will hike now or not hike. It simply said, this data is very hot, much higher than expected. And therefore, we, the market, need to change the probability distribution. We're not saying yes or no. It's not a voting machine of yes or no. It's a voting machine of probability distribution. That's why the markets move all the time. Okay. So in terms of, does that make sense, everyone? Are we good there with that? Okay. So that's the thing. It's not binary. Markets are not binary, guys. When I say binary, I hope we all understand, just means yes or no decisions. No, that's not what we're trading. We are trading different probability outcomes, right? So again, if we go back to the CME FedWatch tool and we do the compare function, which is quite useful, we can see that, let's say, for example, this is one hike. Is this on the screen, guys? The blue? Hopefully we can see that. Now, what you can see is that right now, there's a 39.45% of one hike. But then we said, oh, doesn't that mean 60%? No, guys, because some market participants actually think 11.5% of people actually thinks the Fed's going to hike twice. And actually some people, 1.3%, the Fed's going to hike 3 times. And mathematically, technically, there's 0.22% of market participants who thinks the Fed will hike 3 times. So the point is that when the markets move, they change the distribution of probabilities. They're not saying, oh, they put the finger out the window for the wind and say, oh, yes or no. It's simply so we can see. So that's where we are today. Now, if we go, let's say a week ago, actually, that was a day ago. If we go a week ago, what was the probability? It was 38.2%. And now it's 39.45%. So the point is, Yassine, the big thing is to say, well, how much should the markets move? Of course, that's difficult. Now, I can tell you that the SOFR contracts for December 26 moved exactly 12.5 basis points, which is, drum roll, boom, half a hike. What's a hike? 25 basis points. What you'll find is if you have very strong data, often the market will say, oh, we don't know, let's call it half a hike or half a cut. And that's why I personally, when I trade, I have all the SOFR contracts up because that's giving me very interesting information. Maybe I'm not trading the SOFR, but that's telling me, and that basically went boom, it dropped 12 and a half ticks, actually 25 ticks, 12 and a half full ticks, which is 12 and a half basis points. And then the market just stopped, said, okay, that's enough. Let's price in half a hike. Now, why did it do that? Obviously, the headline number on the non-farm payrolls, it came in at, I think, 172,000. Expectations were 80,000, something like that. So again, guys, you have to think about the standard deviation and say, is that just a beat? No, that was like a 2 or 3 standard deviation beat. Now, if you know your standard deviation, you know that if you're beating by 2 or 3 standard deviations, that's only like a 1 or 2% chance. So putting that in simple English, the result was very, very unexpected. Very unexpected. So the algorithms and the electronic trading just goes brrr, mathematically, it has a very strong reaction just because it's a crazy number. Secondly, the most important number, in my humble opinion, was the revisions. Now, you know, with the non-farm payroll number, you have the 2 previous months revisions. So the numbers we received last Friday were for May, and we had revisions for March and April. And you guys will remember the revisions were 93,000 positive, 93,000 extra jobs. So the way you have to think is not only was the headline number, so think about it this way. Everyone's very concerned about the Fed. Okay, great. That's the big picture, the narrative. The expectation was for about 85,000. So number one, it came in at 172. You go, oh my God. Plus the revisions, which were another 90,000. So it's like the headline number, guys, was not 172,000. You have to think it's like 260,000 headline plus revisions. It's like 260,000. So think about it. The market mathematically is expecting the algos are programmed for, 60, 70, 80,000. And the real number comes in at about 260. That's like a 6 standard deviation out of consensus result. So the markets, obviously, the electronic markets were going to go crazy. You just go brrr. And then once that starts happening, anyone who's long, they're going to immediately get stop losses, and it's just going to cascade and cascade and cascade. And that's why we had a strong reaction. And then the bond market doing that, of course, that bled over into, FX, dollar ripped higher, gold collapse, and equities didn't like the higher yields and the fact that the Fed is pricing higher. Yassine, so far so good? Makes sense.
Yeah.
Now, isn't it an exact science? No, but I would argue in a certain sense it is, because if you know the consensus and you know the standard deviation, you could go, like technically, if you're at Goldman Sachs, that would immediately pop up and say 5.2 standard deviation beat. Now, because I know you have a mathematical background, that a 5.2 standard deviation beat in percentage terms, as you know very well, Yassine,
An outlier.
that's not an outlier. You're being too modest in your language. That's a crazy extreme outlier. As you know, that's like probably less than 1% mathematically. So is it a science? One could argue in a certain sense, yes.
But
So
taking into consideration the context and the inflation focus, average
yeah,
hourly earning came in line. This was my concern.
yes, that's a great point. So what Yassine's saying is that average hourly earnings, okay, that's an excellent point. And I'm going to be honest with you and say that I personally was thinking exactly the same thing, that the average hourly earnings came in line. Was it lower than expected? Maybe it was even lower. No,
It was fine.
it came in lines. And so therefore the
0.3.
logic could be, hey, inflation pressure is not too bad. That shouldn't concern the Fed. At that point, Yassin, you're correct, but you cannot ignore a 5 or 6 standard deviation job market results, because what does that mean? It's so strong that it's almost like une vague, like, it's like a wave which overwhelms the average hourly earnings. You have to put it all together. Is it an exact science? No, no. Put it this way. If, for example, the jobs number had come in consensus, 65 or 70,000, no revisions, and the average hourly earnings was in line, what would have happened? Probably the bond market, the 2-year, would have ripped higher. So you have to put them all together. I mean, it's tricky. As I always like to say, if we all knew, we'd all be on our yacht in Saint-Tropez, right? So it's tricky. But the main thing there was really that the number was just extremely out of consensus. If you look at the Bloomberg survey of, the economists, they normally had 60 or 70 economists. Nobody, I think the maximum from memory was 110,000. And it came in 172,000 plus revisions. It's like, boom, hit the market. Are we good, guys? Any other questions on that? Okay, so what's the other question then about CPI and PPI?
Yeah, CPI. For the CPI, I stick to my thesis. CPI is the focus of the Fed and the market, and I decided to trade if we get a lower than expected core CPI, because as you shared and as we saw on Bloomberg, the positioning is bearish on the 2-year. Everybody is expecting a hot CPI. So we get a soft CPI, and I was expecting a short squeeze on the 2-year,
Yeah.
but that didn't happen. We get a muted reaction. We had a rally, but it wasn't a significant rally as I
Yeah,
anticipated.
that's again, it's tricky because when you say a soft CPI, let's be more specific about that. The headline, I don't think was soft. I think
Core soft CPI.
yeah. Okay. So it's a mixed number. It's a mixed number. The headline was still strong. It's like the PPI we had this morning. You could argue that the core was reasonable. I think it was only 0.2, but the headline was nasty, but the headline was completely expected. So your question is, why didn't the market rally? Because it's complicated. I don't have a simple answer to say, oh, it should have done something. The reality is that, it could have been worse, but you could then step back and say, hey, it could have been a lot better. Like at the end of the day, we had a core PPI today, I think of 6% or something. Was it? I think 6%. So you could say, oh, is that expected? Yes, we all know it's energy prices, but it's one of those things. It's a messy number, and I know you're probably frustrated going, oh my God. I mean, data is difficult to trade, to be honest, especially when you have mixed numbers. It's not easy at the moment. It's not easy. And I agree with you, because I was looking at the core numbers and saying, hey, that's not too bad. But maybe the best way to trade that then is to say, well, okay, if that's the case, what do you know? And maybe should we look at a chart? Maybe let's look at a chart and have a look at the price action. Would that be interesting to everyone?
Yes.
Yeah, you can go like that, guys.
Yes.
Okay. So often if you're a bit confused, if you have a thesis, so what we'll do here, let's look at the 2-year. As we're looking at the 2-year, which is very sensitive, as we know. So what I'm going to do here, I'll just clean up a few things, make it nice and easy peasy. Sorry, guys, I've got a lot of stuff on my computer here, so it's what am I trying to do here? Put white page. There we go. Sorry, guys, because I have all your faces and I have all the Zoom stuff, so it's kind of hard to see stuff. Okay, so let's put this. Oh my God, sorry, I can't see. Oh, where's my? I'll put it on a 3-minute chart. Okay, so it's a 3-minute chart. Oh my God, look at that Trump headline here. Wow. That's the trade, Yassin. Make your life easy and trade stuff like this. Okay, so let's go back in time. What was the date of CPI?
Yesterday.
Yeah, okay, so yesterday, so we're talking the 10th. And we're talking 8:30 a.m. Agree? So what I want to do here, guys, is to look at the price action. Let's see if this works. Boom. Okay, I think we're good. So can you guys see that? Right, sorry, my computer's very sticky. Okay, so let's first of all, you shouldn't be trading in the first minute or so, but what we can observe here, this is the data here, 8:30. Can you guys see that? Is that clear enough? Okay,
Yes.
so the point is, Yassine, look, it did spike up. So your thesis was correct. The market, or the algos, I should say, the algos actually said, wow, our core CPI is lower than expected, and it liked it. So maybe that was it. It's not that you're wrong, but then it comes all the way down. Now, what I'm trying to say, if that's your thesis, this is 3 minutes. Maybe if we go to 1 minute, let's see if I can go to 1 minute. Probably I'll have to redo this. But even if we go a bit more granular and go, hold on, so that's still on. I'm going to have to redo it again. Sorry, guys. So we look at it on the 1 minute. Let's have a look on the 1 minute chart. Maybe it's even better. So this is 1 minute. So this is what you have to think, Yassine, and everyone, when you trade data. So the market in 1 minute rips higher because on the lower than expected core CPI. Now you have to sit on your hands and say, I'm not going to do anything. And you say, well, then you take an extra 5. That's what I do. I take an extra 10 or 20 seconds to kind of look at the data and I go, well, I understand it's a hot number, but we're expecting a hot headline number. And the core number is actually not too bad. So then you need the discipline to say, well, what I do know is that it shouldn't be a disaster. And what I often do is say, listen, if it gets anywhere near the opening price or P1, price level 1, which is here, you see here, that gave, so actually, to be honest, it gave you a pretty nice opportunity in the second minute. And if you had incredible discipline in the third minute, and actually, if you were a great trader, one could have, let me just try, where are all my tools? Where's my toolbox? Technically, like I'm saying, Yassine, the perfect trader, you could have got in, I don't know, down there, and you say, well, you know what? I'm going to take a few ticks. You could have got, let's say, 10 ticks, for example. Now, that is the perfect trader. But my point is that your initial theory was correct. Did the market go higher? Yes. Did the market go lower? No. If you actually look at that 1 minute chart, the ZT actually never, for the first half hour, it didn't actually go below P1. Remember, there's a lot of algos going like this in electronic trading. It's not, most trading is electronic. So you have to go, I think this is not bad. So you say, okay, I'm going to wait for an amazing price. I don't think it should go below P1. And sometimes, what does that mean? Sometimes that means you're going to miss out on an entry. Sometimes that means you're going to have incredible discipline. It's complicated, it's tricky. But what I'm trying to say is, had you waited, you could have entered, maybe not the perfect price, but a very good price. You could have got, 8, 10, 12 ticks on the ZT with a bit of size. That's a very nice day trade.
Actually, I made some money, but I was expecting a significant repricing yesterday because I took the trade. I was in the money. I hold. Then I looked at the gold and the Dixie, and I take also equities. And I saw that the gold came back to P1, and I said maybe I will not reach my profit target, which was I think about 14 or 16.
No. Don't have profit
It was
targets on
the
data.
break of the spike, the break of the algo spike. Then I get out.
Yeah,
in
exactly. You
5 or
have to be looking at correlations. You remember, at the end of the day, it's delicate. It's complex matrix of interrelated factors. The point, Yassine, and everyone, is that you could say it's expected, it's priced in, but the reality is you've got to also say, for the ZT, the front end bonds, to rally significantly when headline inflation is over 4%, it's going to be a difficult sell. I understand core was lower than expected. But what I'm trying to say, Yassine, at the end of the day, it's over 4% inflation. So the bonds are maybe going to say, oh, that's not too bad. Not as bad as feared. The logic should not be, oh, that's great. The logic should be, okay, we dodged a bullet. I don't know if you know that expression in English. We dodged a bullet. We avoided, a bullet. We avoided the worst possible scenario. So there's a little bit of relief. So what you
It's
do, you
like a
take
B opportunity, not an A plus opportunity.
no, it's a dangerous opportunity. I was doing the
Like
same trade.
B.
You go, okay, I'll take a few ticks. You must have incredible price discipline, get the perfect entry price, and you cannot be avar, you cannot be greedy and say, oh, well, I have a profit target. I have no profit target. I'm looking at all the correlations. As I'm trading that, I'm looking at 4 or 5 correlations, the dollar, the other bonds, gold, etc. And as soon as they give you any indice or clues that the market is not clean, you just say, okay, great. I got 3 ticks, good. Time for a cup of coffee.
Well, there is no risk reward because I'm risking 3 or 4 ticks.
That's a you problem. That's not a market problem.
Yeah, you're right.
Data is very fast moving. It's algo driven. You cannot think in terms of risk reward. And to be honest, Yassine, I fully respect if you think it's too choppy and it's not an appropriate risk reward, absolutely don't take the trade. Absolutely do not take the trade. I agree with you. Yeah.
Angus, sorry, is it normal that the VNQ started going up before the CPI was released yesterday? Before the data came out, before it printed, the thing started going up.
Why not? And everything's normal. If it happens, it's normal.
Yeah.
I mean, I don't know. I mean, the thing is, guys, I don't know if you're trying, John, to talk about a conspiracy theory and inside data. Maybe. What I'm trying to say, that to me has never been useful or helpful because I don't know. And it's speculation. And I am a big proponent of the theory that one just trades what's happening. Maybe algos are positioning. It could be, I mean, a lot of algo, think about it this way. I often, if I'm in an open position, you have to understand that data represents risk. Let's say, for example, you're massively in profit on NQ. And your risk manager, you're at an institution, you go, okay, guys, it's time to profit take. And you go, oh my God, we have CPI in 10 seconds. What will you do? Maybe you exit. Maybe you want to be long. I don't know. We don't know. There's millions of different people and institutions and programs doing all kinds of things. I don't know. It could be people entering, positioning, could be leaked data. It could be people taking profits, exiting. It's very typical for institutions and actually normal traders to exit. But I regularly, if I'm in a nice position, data represents risk. I may not want to risk my profits. I'll just, and I personally, I can tell you, I've often exited trades 2 or 3 minutes before the data or 10 seconds before. I'm just like, okay, I'm out of here. I don't want to risk it. It wasn't me moving the market. But so what I'm trying to say for sure, it could be anything. It could be insider trading. God knows, maybe some people traded it, but don't think that way. That's just going to mess with your mind. Oh, Trump's friends know Trump, blah, blah, blah. Who cares? And at the end of the day, you don't know. So I just trade what's in front of you and get good entry prices. Okay. And for sure,
I don't mind.
One more from you, Yassine. Well, hold on, Yassine.
Yeah.
Any other questions? But we might get back to you. We don't want you to hog. Do you have some other questions, guys? No?
Angus, I had that question about the way Marco trades options.
Okay, well, I obviously have no idea the way he trades, and I wouldn't presume to talk on his behalf. So if you have a specific or a general question, theoretical question, not what is he doing, because that's obviously a question between you and Marco. Yeah.
No, my question is, I wrote it down yesterday on the thread. When he's buying zero term or zero, and then he's buying a call and a put at the same time, and I guess he lets one go and takes profit on whichever way it goes. And a lot of times the people that are doing it with him will say the delta is too high to buy this one or that one, which I kind of get. And I kind of get about the leveraging with the delta. I remember a few years ago, you taught me when I was a beginner, why not buy in the money, which is the opposite of this. But I was just wondering.
Okay. The first thing I would say, Kim, is that to be honest, there are not enough specific details to answer that question. I mean, if one is buying I mean, the choice of course, as I've always said, and again, as I keep on trying to say, to explain options requires maybe a 12-month course. It's not a 5-minute answer. But what we can say in 5 minutes is the choice of delta is neither good nor bad. It simply achieves different things, right?
Mm-hmm.
And it's pretty simple. If you're buying an at the money delta, be it a call or a put, you know, that's going to cost you a certain amount of money. You're essentially paying for a lot of volatility because it can go very quickly in the money or out of the money, and that's going to be expensive. If you're buying a deep out of the money delta or put, obviously there's less premium, but of course you're going to have less sort of premium will not move as much because the delta is low compared to the underlying. So it's not cheap, and also has a low probability of going in the money. So it's not cheap in any sense. It's cheap for a reason because it's trash. On the other hand, trash from a probability point of view, it's not a bad thing to be doing. On the other hand, if you're buying a sort of more deeper in the money put or call, you're buying more intrinsic value, and therefore you'll be able to participate more with the movement of the underlying. So the point I'm trying to make, the very simplistic point I'm trying to make, is that the choice of delta is a strategy choice. It's not good or bad. All different deltas do different things. Now, if someone decides simultaneously to be buying a call or a delta, sorry, a call or a put long, I mean, the classic thing is that's a straddle, right, at the money. So what you're actually trading there is not direction. You're trading volatility. Now, if you do it not at the money, so a little bit, you know, away from the, you know, at the money, obviously that's a strangle. Let's say a 40 call and a 40 delta put. But essentially what you're doing there is it's a bet on volatility, not so much. You're basically not expressing a viewpoint on direction. You're expressing a viewpoint on the magnitude or the degree of volatility. And you're essentially saying, A, I don't have a directional bias. B, I do believe that will move in a certain way. Now, obviously, to say, well, I don't know which way it's going to move, and if it goes up, I'll take a profit, and if it goes down, I'll take a profit. That sounds pretty good. That sounds like chocolate cake for breakfast every morning, but it's not that simple, because obviously, if you're paying premium, therefore, if you're paying premium twice for a long call and a long put, you're paying double the premium. So first of all, you need to make sure that any realized profit will also pay for the premium you're losing on the losing side. Secondly, the most sophisticated sort of algorithms in the world belong to option market makers who set the price. And they're very, very smart and normally very, very accurate. And it's very rare to find, there's no free lunch in option trading. So the point is, obviously, it'd be kind of a nice simplistic way to look at the world and say, hey, it's going to go up or down. I'm going to buy a long call and a long put. And for sure, if one goes up, you'll make profits on that. But of course, you also have to cover the losing premium. So there's two ways to make money on a straddle or a strangle, if indeed that is the structure to which you're referring. And that's if the implied volatility for which you paid as the premium suddenly goes higher. That means that, you know, both of your sort of long options will gain in value of the premium. So that's a good thing. And obviously, if the market moves in an aggressive way, which the market makers hadn't priced in. So can you make money on straddles and strangles? Absolutely. Historically, is that a winning structure? No. That's why the biggest trading firms in the world are market makers, like Citadel and these guys. Why do you think they make hundreds of billions of dollars a year? Because essentially, premium is priced like insurance. You just got to think simplistically, premium is like insurance. Why do insurance companies have profits? They have billions of data points and the most sophisticated models in the world, pricing options so they don't lose money. So essentially, you're always, especially on the put size, you're always overpaying. Now, can you get that right? If you're very good at calling direction and market moves, for sure. But in general, I've read quite a lot of stuff. Like as as a, let's say, a systematic approach, buying straddles and strangles, if you do it systematically, it actually loses money. Just because the market makers charge a lot of insurance premium, essentially. Now, I'm not to say on individual trades, can you make money? Absolutely. But that's a question of, do you get, as I say, the implied vol goes higher, so the premium goes higher, great, and you get an extreme move, or let's say not even an extreme move, a move which is not priced when you enter the trade. So what we're basically saying there is, it depends on each individual trade. Does it work sometimes? Absolutely. Does it often not work? Absolutely. Of course, the other issue as well is that, let's say, for example, you have an implied volatility on both of your legs of, I don't know, let's call it 35%. And let's say, for example, implied volatility, let's say the market goes in your direction, or actually in your direction, you have both directions. Let's say implied volatility in general, let's say the VIX comes down, automatically the cost of your premium, the value of your premium will decrease. Of course, one of the inputs into premium price is implied volatility. So you have to guess the volatility and the magnitude of the move in order for that trade structure to work. Now, is that possible? Absolutely. Is it an easy path to riches? I would suggest not. But does that help a little bit? Or, I mean, I sort of don't exactly know the question. Like, is it like I'd need a specific trade, or like it completely depends. So, for example, at the moment, implied volatility is very high, or it's quite high in the stock market over the last 2 or 3 days. So that's actually that's a very, very bad moment to be buying straddles or strangles, because you're paying a chunk of money incorporated into the premium, a lot of money. So if anything, it's an environment to be selling volatility, not buying volatility. Just remember that when you're doing those kind of structures, you need to have a very good viewpoint, or a strong viewpoint on volatility, because it's essentially a volatility trade. It's not really a directional trade. It's irrelevant if you think Apple's going up or down. You're basically saying, what is the magnitude of the expected move? And secondly, will the implied vol at which you entered the trade, will that increase? That's what you're hoping. Actually, that's what you need. Does that help at all? But I mean, I don't know the exact trade, so it's hard to be specific.
Just Marco's always buying QQQ calls and puts at the same time with a few different prices. And I can't figure out quite what he's doing. I try to follow, but the stream always cuts out. But
yeah,
maybe it's too much for me, and I should do something else.
No, but when you say that, I mean, but what I'm trying to say is, without the specific trade and the specific circumstances, it's difficult for me to make any kind of.
I don't know what day it was or the volatility.
But what I'm trying to say is that if you're buying calls and puts simultaneously, you are essentially doing a straddle or a strangle. Mm-hmm. And I mean, possibly I'm trying to think if the logic could be, if you're expecting large directional moves intraday, the bet would be, I think that let's say the call works and the market goes up, you will obviously collect a profit, and you're essentially hoping that outperforms the loss you will take on the loss of premium. Or if you believe it's got to be a range bound day, and one could say, well, hey, the call will go up and eventually the market will go down, and maybe in the afternoon I'll collect some money on the way down as well. But as I say, I would have to know the specifics, and it's a pretty vague question, to be brutally honest about it. And I'm just trying to say that I personally don't recommend that as a general strategy. All the research I know about, that's a losing strategy, medium to long term. But again, I obviously I'm not going to talk about like what Marco does. You'd have to see the specific day and the specific trade and the strikes and the context. There's like 20 different factors before, so I'm not really comfortable talking about that without the details. Sorry. Okay, guys. Another question. Jimmy, Vitaly, Nick, Dushayub.
Hey, Angus, I have a question on.
Yes, Jimmy, go for it.
Okay, so like I know we all have our different styles, right? But for me, I'm more of a long-term investor as opposed to a day trader.
Okay.
But let's say for long-term investing, if you can answer my question, I have a concentrated position, and the market has moved against me the last few days here, and I have a pretty big loss, I would say. Now, if I predict that the market is going to move even down further, what option strategy would you recommend for me, I guess, to protect more further downside? Would you buy a put option like further out, maybe, I don't know, 6 months from now?
Okay, well, what can we look at the chart? Is that when you're comfortable just telling us what this is? It's interesting to look at the chart.
As you mean the stock?
Yeah, what is it?
Yeah, so I'm trading Amazon.
Amazon. I've heard of those guys. Amazon. Hold
So
on,
I'm not really worried with the volatility, right? But just more to protect further downside, right?
Yeah, I mean, let's just open it up. All right. So, so I'm just going to put it on a chart. Okay, so let's do a little technical analysis. Oh, that's a 1 minute chart. I'm thinking, wow, that's you'd probably like that. It was only that move. Sorry, let me just. Sorry, I can't. Oh my God, what's going on here? Sorry. Technology. Okay. All right. So I'll put that up there. All right, Amazon. So, okay. Let's have a look at this from a technical perspective. What do we see? We see that it failed to make a double top. Okay, first of all, obviously the Fibonacci. Now, first of all, what I would say, Jimmy, is that it seems to be coming into an interesting sort of Fibonacci level. So that's going to be interesting.
I mean, for the last week, right, it's just getting pounded to the downside.
Yeah, but hold on, let's just check it out. So we're going to do a full technical analysis on it. Okay, so first of all, this is kind of nice because at the 50% fib, so you see I've done the Fibonacci here, it's started to get a little bit of help. So that's interesting. Okay, now what I normally like to do before you sort of panic or anything, I normally, as I say, I'm going to just throw on a few different indicators here because I like to, when I look at something like seriously, I like to. Sorry, it's just that my computer is so sticky here. My God, why is it so sticky? Man, this is annoying. So I'm going to do it like this because you guys can't see, but I've got all this stuff cluttering up. Okay, so I'll make it a bit smaller there. Okay, so let's just put on some moving averages. I can see those. Sorry, this is a nightmare. Oh my God. Sorry, guys. I just literally, my mouse is not moving at all.
Okay.
No, it's not good because it's, sorry, just, why is this not, sorry, guys. It's literally stuck. Sorry, just bear with me. Let's see. Maybe if we get rid of everything. Okay, maybe this is going to be better. Okay, sorry. All right. Okay, so first of all, it's broken down through the 100-day moving average, kind of bouncing off the 200-day moving average and a fib. So that's not bad. Okay, now I want to also look at some other technical indicators, which I'm going to do here. I've got something which I look at. So if we look at the stochastics, let's have a look. And you can see here that, you know, it's not massively overbought. So could it go more to the downside? I would have to be honest and say yes. It's not massively overbought. It could do that. The MACD's got, it does have a little bit more room on the downside. So my first sort of thing to say would be that, okay, the good news is that it's sort of, you know, at the 50-day moving average. Now, what I like to do, Jimmy, is to say, well, okay, what do the bulls need to do here? So I technically always like to break this down into like a 4-hour chart, which is not too long term. It just gives me a bit of a sense. And my personal way of always looking at trades I'm in is to go, well, okay, what do the bulls and bears need to do? I'm always trying to figure out who's in charge and like little hurdles. So let's just first of all look at a reversal. Now, it seems to me that, okay, so far, in order to get any sense of whether the bulls have actually sort of picked it up here. So you see what I've done? I've drawn a fib from this sort of shorter term one. This is a 4-hour chart here. So at this point, obviously, this is simply a very, very small reactive bounce. And there's nothing bullish about this. To be honest, at least it has to get up to, let's call it 250, 251 up here. And then ideally through that 50% retracement at 255, and then above the 61 at, let's call it 260. So to be absolutely honest, you can't really say that this is in recovery mode, in my humble opinion, until it's got above there. But the good news is that it has sort of stabilized a little bit around that sort of longer term moving average, and especially on the fib. What you don't want to see in terms of also bad news now, that would be the bull case. Now, what would be the bear case? Obviously, is if it fails. Can you see the chart? If it fails here at 250.91, this sort of level here, that would be very pessimistic. So what I'm trying to say, before you sort of start worrying about your position, let's observe the price action. It's always important, because where I personally would sort of, I'm not going to say panic, but just say, okay, that was the first task which was failed, is if it cannot get there. What you want to see is it sort of at least the bull's pushing above that. If, for example, you see a pretty sort of soft price action, let's say on the ghost feed here, you see it sort of do something like this. It gets sort of up there, but then it kind of fails there. That is not necessarily great. Okay, so that's something which you want to be looking out for sure, is if it fails there. And obviously, if it pushes up there, that's going to get good. Now, obviously,
looking at, would you be looking like at a 2-week period?
Well, no, I'd just be looking at the price action. I mean, this is a 4-hour chart, but I'm just looking at the price action. Of course, what I'm trying to say is technically here, see, if I was a bull, if I was trying to sell you Amazon stock, I could say, relax, Jimmy. On the longer term chart, as you can see, it was bought at the 50% retracement. This is bullish. There's actually, see this doji here. This is actually a rejection doji. Nice green candle. Let's put it back on the daily chart just to keep it clean. I would say, listen, it came to the 50% retracement, didn't go below there, and there's a nice a retracement. And what we need to see now, I could even say to you, so the measured move, I would say, well, if I did a fib extension, I would do this. And I say, well, what's the profit target? And I would say, well, maybe something, Jimmy, like this. I mean, one could argue from a technical perspective that this has been in a great bull run. I mean, let's just get a bit of perspective here on Amazon, like most of the charts. If we put it sort of like this, I mean, does it look that bad? I could say, well, look at this. I mean, does that look so bad now? Not especially. And I could say that in this most recent sort of price action or impulse, for sure, there's been, blah, 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 all the stuff, tech, we all get it. Everything's been selling off. It came into the 50% pocket, the 50% Fibonacci retrace pocket, and now it's heading up. And actually the Fibonacci sort of price target extension, one could argue, is maybe new highs and maybe even a bit higher. Now, but we don't know that yet. I would say that at this point, it's neutral. So in terms of, oh my God, it's going down more. So in terms of protection, do you own the stock, or are you in an option structure at the moment? So when you say it's gone down, do you own the stock, or?
No, straight up stock.
Okay, so you have the stock. Okay.
Yeah.
So of course, what you could do is to buy, if you want further protection. So obviously the problem is that because the stock has come down, as you know, puts protection has become more expensive and implied volatility has gone up, correct?
Correct.
So this is actually a pretty horrible moment to be buying protection. Never buy protection at the lows, because you're paying for very high implied volatility. Sorry, you actually know that, but I'm just saying that's the reality. Okay, so are you prepared to take more of a loss for it?
Oh yeah, I'll hold it forever. I guess, to be honest with you, I'm talking about like.
Whoa! That's a big man talking. I'll hold it forever. So why are we having this conversation?
Yeah, I guess my point is, if there's a way, I guess, to limit any downside.
Okay. Well,
that's all I'm just exploring here, right? At the end of the day.
If you truly want to limit downside, but you're saying you want to hold it forever, well, what you could do is we'll sell some calls. I mean, okay, because remember that if implied volatility is high, that's bad, obviously, if you're going to be long volatility. Remember, Kim, if you're long volatility, so longer put structure, that is a problem. So obviously you say, well, on the other hand, I could profit from the high implied volatility by selling calls. Now, obviously you don't want to be called away tomorrow. So then the point would be, to identify a point on the chart where, you're getting some decent premium and where, you don't want to lose the stock, because I'm presuming that you're a long-term guy, you don't want to lose the stock.
Yes.
So I mean, realistically, as I say, if we're looking at some Fibonacci retracements, I don't know, have to look at the option chain. I mean, the market's closed now, but maybe you could, sell a call up here, 260, 270, something like that. Now, keep in mind that in terms of option mathematics, as you probably know, the shorter the expiry date, mathematically, the more bang for your buck selling options. You're familiar with that? Right.
Yes.
So I'm not at all suggesting selling monthly calls or quarterly calls or yearly calls, because that's not good. Also, you have less control. I would potentially, let's say even tomorrow morning, look at the Amazon option chain and say, what about a weekly calls? I mean, if you can continue to sell weekly calls, you're going to get a bit of premium.
Yeah.
And if the market goes up, you could, and you're getting a bit nervous, you could always, you could roll it into a higher strike and roll up and out, so to speak. So let's say we're at 260, say, oh, I don't like that, exit that, and then make it 270 and another week, and just keep on rolling it over and rolling it over. Now,
that's a way. Perfect.
That would give you a little bit of income, but of course you don't want to make that too tight, that strike, because you don't want to be called away tomorrow and like, oh my God, I lost my stock. That's not the thing. So what you could do now, the other way, there is a couple of other things as well. If you just wanted to buy a put, that's going to be expensive.
Yeah.
So then the question is, well, what are you really worrying about? I mean, if you genuinely don't care how much, I mean, do you want to own more of this?
Eventually I can average down. I'm not considering to do that right now because I don't know how further down it can go.
Well, the point is, again, the other thing which is going to pay you more premium is to sell some puts. Right? Now, if you honestly want to hold it and you're saying, hey, I don't mind owning Amazon at, let's look at the chart. I mean, what would be a nice price? Would you be comfortable at $200, for example?
Sure. Yeah, okay. It was 199, I think.
I mean, this is the other thing as well. Same logic. If you don't mind being exercised, which you probably wouldn't, you could sell puts, let's say with a strike of $200. You would, two possibilities. You would collect premium. Again, I would suggest it on weeklies because the premium would be much juicier. And the option, the implied vol is high at the moment. You could sell, let's say, 200 puts. And if the market doesn't go down, okay, you get premium. That's nice. And the market's going up, you're probably going to be a happy guy anyway. In fact, you could sell calls and puts. So you can get some premium on the top side and some premium on the downside, right? You could do both. And let's say, I mean, it's a pretty big drop, but let's say, for example, I don't know, in the next week, is it going to go down 15%? What's that, 16%? Probably not. But the point is, if you are genuinely happy to accept Amazon stock down here, and you have to answer yourself that, are you genuinely happy? Because you're going to have to minimum get 100. You could sell puts down there with that strike. And you could just keep on doing that. And let's say the market went up a little bit, you've sold calls on the upside, you've sold puts on the downside. So technically, you could collect premium on both sides, if you know what I mean.
Yes.
So you're selling calls on the upside, get a bit of premium. And if you're, happy, as I say, if you are exercised, I mean, 16% is a big chunk for Amazon on the downside, but weekly, short term, so you keep control. And again, now the other possibility, if you just want to buy basic protection, you could buy a put spread. So rather than just buying a long put, you could say, well, hey, that's going to cost me quite a lot of premium. Same logic. You could sell the put, but you could do a long. So you do a long put, let's say at the money, and sell, let's say, the $200 strike. So you're collecting some premium, which would soften a little bit the cost, the outlay. Now that's not going to give you full protection, but it'll give you something. But again, I probably wouldn't recommend that because at the money, a long put at the money is going to cost you a lot. If you're happy for it to go down a bit, I'd maybe go for a delta of I don't know, 38, a little bit out of the money or something, 35, 37, 38, 40, 41. Like, see the delta on the option chain. So you're basically saying, hey, if Amazon goes down another 2 or 3%, whatever, because it's going to be substantially cheaper to buy a long put spread. So you buy the put, let's say 40, 41 delta, and buy and sell the put at, let's say, whatever, 15 or 20 or something like that. So you'll collect a bit of premium and you'll still have reasonable protection. But again, you know, the point is, if you're, that's why I think when you blithely and with great insouciance say, oh no, I'm never going to sell it. Why are you wasting money on protection? At that point, you're in a perfect position. You can be institutional, like Warren Buffett used to do, and just sell puts all day, collect premium, and sell calls as well. So that's potentially what you could do. But again, I'm not saying, if you're genuinely saying I'm never going to sell, like,
well, like I said, Angus, like I don't mind keeping the stock like 5 years, right? 10 years.
Now there are some slightly more exotic ways of doing things. I mean, which I don't really want to get into, but you know, if for example, you could sell a put, get some premium income, and with the income, you could maybe even buy some calls at the money calls. And you say, you know what? If it goes down, the only problem there, of course, you could lose more money from your call premium. But the good news is that if it goes up, if you get lucky, good, you would say, hey, I'm profiting a little bit from the long calls and the premium from the sold puts.
Yeah.
Because think about it, you could do a combination. You could sell some puts, you could buy some calls, and then sell some calls. So technically, you're doing like a call spread at that point.
Okay.
But that's getting a little bit exotic. But really, I think the key question, you've got to really say, what am I trying to do with this stock? Because if you genuinely are okay for it to fall, and you genuinely do not mind investing a bit more, or you're able to invest a bit more, remember that one contract is 100 shares. And again, I have no idea of your financial situation, but $200 times 100 is, someone did the maths, what's that? Is that 20K? You know, maybe you do or you don't have that money. So I'm just trying to say, talking selling puts, I want to be very, very, very clear that you have to have the money in your account to cover that, which maybe you don't.
Yeah.
In which case, selling a naked put is completely not
I've never done it
at all. But again, as I say, you could also sell a put spread.
Yeah.
So sell the put and then buy the put underneath it. So let's say, for example, you know, you don't want things to go too crazy. You could sell the put at, let's say, 200, strike of 200, and buy a call at, I don't know, 190 or something, or 195 or something. And that way, you know, if things get too crazy. But again, because all I'm trying to say is that with implied vol relatively high, and unfortunately, as I say, the option market is closed, so we don't know the implied vol. I don't know it offhand of Amazon, but I'm assuming that it's relatively high compared to its historical situation. You're in a good situation, because if you're a long-term investor, that's pretty nice. You could actually be selling puts or selling put spreads and also selling calls, almost like a covered call kind of situation. So you could get a bit of premium on both sides.
Perfect.
Which is kind of a nice place to be honest. And again, I would do it, like technically even zero DTEs. I mean, I don't know if you want, do they do those on Amazon? Maybe. But maybe let's say weeklies, because the weeklies, just the mathematics, they roll over quickly and you get pretty good return when you're selling, because remember, you're selling theta then. You're getting nice theta burn, nice time decay burn. So that's what I'd think about.
Very good, Angus. Thank you so much. Appreciate it.
Okay. Time for one more quick question, guys. Yassine, do you have a quick question?
Yes, I have a quick
or anyone else? Yeah.
Yes. What are your thoughts on SpaceX IPO tomorrow?
Well, I'm not an expert on IPOs, nor am I an expert on space. I'd probably prefer not really to give an opinion, because I only like giving opinions on things which I'm very well informed about. What I've read, which is probably what you have read, I don't know. I mean, what I'm going to say, personally, I'm not a fan of Elon Musk. So my personal view, I mean, who cares what I think of Elon Musk? In fact, I'm not against Elon or pro Elon. All I would say is trade the market as you see it. And I would be personally, I never trade on personalities or what I think of people or are they visionaries or whatever. I mean, one could argue that we all know that, you know, Alphabet did $80 billion of share issuance. It looks like Meta's going to do the same. I think Google was up in Canada with a big share issue, sort of financing issuance, debt issuance. And we've seen that the market has been very weak over the last 4, 5, 6 days. Some people, a lot of people are saying that, you know, a lot of institutions are they've sold some stuff in order to buy SpaceX. So one could argue, Vitaly, from that point of view, that sort of the bad news about all of this issuance and equity issuance is maybe over. And could it go higher? Absolutely. I mean, the only thing which slightly worried me is that the indices, you know, NASDAQ and the Russell, they changed their rules, as you probably know, to allow SpaceX to start trading pretty quickly. As you also probably know, S&P 500 did not. So my understanding is that that's significant amount of money which is not automatically and passively going to be spent on SpaceX stocks. So, you know, the point is, what are we trying to say here? Is it going to rip higher after the IPO? Maybe. Is it going to sort of have a substantial discount after the IPO? Maybe. I actually, on my video about 4 or 5 days ago, I actually put some historical data that most big IPOs 3 to 6 months after are trading at a significant discount. What I would do, there's always another trade, Vitaly. I trade all kinds of things all day, every day. So I have no problem about going, oh my God, I missed SpaceX going up 20%. I just did a beautiful oil trade, 300 ticks. I don't care about SpaceX. There's no, I'm not saying that to brag. I'm simply saying that I'm trying to make an important general point is that there's always another trade. If SpaceX goes up 30% on Friday morning and everyone goes, oh man, obviously every bro on Twitter will be going, oh my God, I love Elon, amazing. But if it goes down 30%, maybe. Personally, I would say that it's an interesting company. He has good political connections. And there's definitely a lot of potential. Okay, but on the other hand, he set the price. The problem is, from what I understand, he set the price with the underwriters at, what is it, $125 or something. He's not allowing for price discovery. That's very unusual historically. Normally with an IPO, you have price discovery. He's saying, oh, the initial price is going to be this, whatever. What I would say, my personal view, Vitaly, is to say the following. If it comes down 30, 40, 50%, I think that sounds like an interesting risk-reward trade. If it goes up, you go, okay, you're going to miss it anyway, unless you're JP Morgan or Trump or an insider, right? So I would simply say, I mean, I have no idea what's going to happen. I don't know. But what I do know is that if SpaceX comes down 30, 40, 50% in a week or two, or 25%, I think that's interesting. Personally, I'll be watching it. And by the way, a lot of people say the first thing is going to be the earnings. Remember, the S&P 500 only lets companies into the index which have made a profit. SpaceX does not make money. Not that we care, because we all love Elon, and we all know that tech companies often, they don't need to make money. But I'm simply saying that when the reality hits and insiders can start selling off their shares, what's that? Is that 3 months or 6 months? I mean, I don't know. I think for me, I'm going to sit on the sidelines and see what happens. But I will say, Vitaly, if it goes down 30, 40, 50%, absolutely, I think it's wonderful. But I'm not going to, on Friday mornings, try and start clicking. That's me. That's just me. Probably wrong. It'll probably go up all day, every day, and I'll be wrong. But that's okay, because I don't care. I just don't know. For me, it's a bad risk reward. I only like to trade where I sort of feel that it's a good entry point and I understand what's happening. There's obviously a huge amount of insider activity as well. Elon, his buddies, his employees, Trump, I don't know, the sovereign wealth fund of Qatar, God knows. Probably Yassin has a few billion. That's my
Anyways,
view. That's my view.
thank you, Angus. I think
Just
it's going to
saying.
be interesting anyway.
It's definitely going to be super interesting. But what I'm trying to say, Vitaly, what I realize as getting very old is that in trading, there's one answer to every question, which is a good entry price. That solves basically every single question. That means if you want to be long a straddle, Kim, you wait for low implied volatility, right? If you want to buy SpaceX, you wait for a pullback. It hasn't even traded yet. So in what sense am I trading? If Elon had come to me 3 years ago and said, hey, you can buy this stuff for $20, yeah, I would have bought it. But he didn't. Because we're not talking at the moment. Okay. Just wait. Look at it. If it pulls back 30, 40%, great. Good.
Angus, question.
Yeah.
When it comes to trading IPOs, I mean, it's really hard to predict which direction it's going to go, right? Because there's always the risk it could go to the downside, right? So wouldn't it be a better strategy, especially, let's say, for me, I'm a long-term investor. Let's say if you consider, let's say, SpaceX, OpenAI, Anthropic, maybe to get like a diversified ETF and just consistently average down and hold it for like 3 to 5 years, because in 5 years from now, they're probably going to be great companies, right? I mean, that would be my approach.
Well, sounds like, sure. But again, with trading, guys, it's the story you're telling yourself. It's probably a great company. It's probably going to be up, right? That's. I'm just quoting you back, Jimmy.
Yeah.
I don't know. I look at the price action. I'm not a guy driven by narratives. Actually, that's not true. I'm completely driven by narratives. I look at the price action.
Yeah.
Sure, diversification.
Fair enough.
I mean, it's also, I mean, it depends on your situation. If you have a bunch of, I mean, what could be interesting once the options start trading, if you personally like SpaceX and let's say Anthropic and OpenAI and all that kind of stuff, for sure, a diversified ETF. If you like that basket, I think at that point, if you're happy to own it at a lower price, and again, guys, this is what Warren Buffett did. It's beautiful, and I do it myself. If you want to own something, the only way to do it, in my humble opinion, well, not the only way, that's a stupid comment. A good way to do it is just to sell puts. Collect premium while you're waiting.
Mm-hmm.
If you guys want to own some SpaceX and let's say a diversified ETF with, you know, some of these upcoming IPOs, yeah, great. You say, okay, I'm just going to keep on selling puts. And if eventually one day it goes down there, yay, I got my 100 shares of Anthropic. Maybe that's going to take 3 months, but that's pretty nice if every week you're rolling over a little bit of premium. That's a beautiful situation. That's what Warren Buffett did. Why not? That's perfect. You say, I'm going to get a great price, and I'm just going to keep on getting some income while I wait. And one day, ding, you're exercised, and you go, okay, cool. I've got it at a 50% discount. Great. So I think, yeah, for sure, that's what I would be doing. I mean, also, it seems to me that in the AI space, there's increasing competition. I was talking to a guy before this call. There's increasing competition. And I think maybe not so much SpaceX, but the guys, Anthropic and OpenAI, it's interesting space. I mean, for sure, they're market leaders at the moment, but I'm not convinced in 5 years. Who knows? Maybe there's some super smart Chinese startup. You know, there's going to be competition. There's always competition.
That's a good point.
So I'm not massively, I mean, for sure, Anthropic looks good. OpenAI looks good. Claude, you know, whatever, great. Okay, we get it. But because I'm old enough, guys, like you look at the dot-com bubble, 1999, everyone used to be on AOL and Yahoo and God knows what else. Didn't work out. So what I'm trying to say in these new technologies, I don't know. I think but what I do know is that it's good to be paid to get a great price. So I'd be thinking of selling puts or even put spreads, whatever. Why not? That's what I'd be doing. Alrighty, Yassine, final quick question.
Okay, so as you know, today you get the PPI core
data again.
over here. Okay, I trade the data. I try to get specialized in the data. This is why I'm sticking to this strategy.
Okay.
Every core came in lower than expected, but this is not my question. My question is not about the data. My question is about the focus of the market, which was today toward the geopolitical headlines. And from my current level of understanding, the market stopped caring about the geopolitical headlines 1 or 2 weeks ago. So my specific question for you, Angus, is how can we determine the current focus of the market?
Oh, Well, that's another big question. You have to use your nose. The geopolitical stuff, you have to say if something has materially changed. So what materially changed over the last 24 hours were two things geopolitically, talking about Iran, was that obviously there was a cessez-le-feu, there was some kind of sort of ceasefire, and Trump said, okay, we are going to bomb. We all know that. And the Iranians threatened to attack oil infrastructure. And they said they were now going to block the Strait of Hormuz. So I think it's possible to say that the status quo of the last 2 or 3 weeks, the cessez-le-feu, the sort of the ceasefire, you could say was more fragile. Okay. Then, of course, we got the Trump tweet this afternoon, basically saying, essentially, there's a deal. It's done. The war's over. Okay. So yeah, you're correct to say, what is the market focused on? And those were two significant pieces of news, which suddenly the market refocuses on the geopolitics and the oil market, et cetera, et cetera. So the question is, well, how do I know what's significant? That's tricky. To be honest, that's just sort of seeing how things react. But what you should know, because if you look at markets all day like me, I literally am in front of the screens for 4 or 5 hours every day. Over the last 3 months, I've seen dozens of Trump tweets or information from the Iranian side, and have observed the market reaction. And obviously the market reaction has been less and less and less. So at that point, you need to have a bigger piece of news to say, oh, now the market's focused on that. And that's just judgment and probably experience to go, oh my God, Trump just said the war has finished. It's officially over. Or we're going to stop the cessez-le-feu, the ceasefire, and we're going to start bombing. You have to sort of feel what's significant. Also watch the correlations. If you watch the correlations, you will see that in the first part of the war, let's say 3 months ago, the price of oil was perfectly correlated to bond yields. So as the oil went up, bond yields went up, and the stock market was anti-correlated, so the stock market went down, right? But what you will have noticed I hope, over the last, thank you for the message. What you will have noticed over the last few weeks is that the correlations between oil and yields became less strong, and also the correlation between yields and the stock market and oil and the equities, let's say the NASDAQ or the ES, it became decoupled a little bit. So the correlations broke down, right? So you should always be looking at correlations. So that is telling you what the market is thinking. If you see the correlations changing, and I'll see if I can find this, guys. I'm going to try and do this. This may not work on TradingView, but let's see if we can do it. So what we're going to do here, this is the final thing. What we'll do, guys, we're going to put up oil. So I'll put up just the CL1 contract, right? And I'm also going to put on the correlation function with, let's say, the 2-year yield. Let's see if I can do this. Correlation coefficient. Okay. So let's type in, I'm going to put, let's see if this works, US02 yield. Oh, there we go. You see what I've done? I'm going to put the correlation of the yield.
Mm-hmm.
Now, I have no idea if this is going to work. Oh, there we go. Can you guys see this chart?
We see just the correlation coefficient.
Right. So what we have on the top is the price of oil. And on the bottom is the 2-year yield, and if they're correlated. Now, what do you notice, guys? You notice that when the war started, where's the war? Which was February the 27th. Oh my God, my screen's not working. Anyway, down here, you can see that the correlation was actually negative. But what you can observe, see how the correlation almost went 1-to-1. You see, at the height of the crisis.
Yes.
Then it calmed down. So it's changing. So my point is, and again, it would be interesting to look at the correlations between, let's say, equities and bond yields, or equities and the price of oil. So my point is this, Yassin, to understand what's moving the markets and what the market is worried about, also look at correlations in a technical sense. Because at the beginning of the war, the equity market was like, oh my God, bond yields are up, and bond yields like, oh my God, we're up because oil's up. So it was oil, bond yields, equities. Equities that way. That was what's moving. Oil. Oil was the only important thing, right? And the US dollar. But as you can see, over the last month or two, those correlations have become less important. So what does that tell us? That tells us that the bond market, rather than being only obsessed by the price of oil, the bond market has switched its attention back more towards, oh, the Fed and your special friend, inflation. And what's the Fed going to do? And economic data. Oh, employment. Is employment strong? Is the US economy? So what's happened is that the market was very obsessed for a few weeks about oil because that's inflationary. It's still interested in oil, but as you can say, the correlations between the equity, it's changed a little bit. And that's one of the ways to figure out what the market's worried about. And also just to look at the reactions. I look at price reactions all day, every day. So you're looking at data. So every time you look at data, you shouldn't just look at data as, oh, did I make money on a trade? You also have to say, what is that telling me about what the market thinks? What is that telling me about what the market thinks? And if, for example, a super high inflation print, the 2-year yield doesn't go down too much more, doesn't go up too much more, what's that telling you? The market maybe doesn't care, or maybe it's kind of saturated. It's like, okay, we've priced in enough hawkishness. We're at the tipping point. We're at a point now where any more hawkishness would damage the economy or something. Like, that's the point. Like, it's not easy. You just have to constantly be looking at it. But at the moment, the market is, I would say, a bit more focused now, except for today, because the headlines were significantly different, right? Significantly different. The market now is much more focused on the Fed, inflation, even maybe not inflation. The question is inflation transitory or not transitory? Transitory or not transitory? Transitory or not transitory? So that's what you have to figure out. That's what the market's really... And now the market, I can tell you, we have Kevin Walsh at the Fed next Wednesday. The market is now going to be obsessed about that for the next 3 or 4, 5 days. That's going to be the main focus. What will Kevin Walsh say and do at the press conference? That's the main obsession for the next few days. Voila. All right, guys, I think I'm going to leave it there. 1 hour and 20, that's probably enough for today. I hope that was useful. I'm going to stop recording, but I won't get off the machine, so I'm going to stop recording now.